Nigeria's tax landscape has undergone significant transformation with President Bola Tinubu's signing of 4 tax reform bills into law. The reforms introduce key changes, including tax exemptions for low-income earners, reduced corporate income tax rates, and a more efficient tax administration system. These reforms aim to increase revenue efficiency, foster a business-friendly environment, and drive economic growth. Effective implementation and public trust are crucial to their success. And Nigeria's tax landscape is undergoing this transformation at this time. And then this sweeping overhaul aims to simplify taxation, boost revenue efficiency, and alleviate financial burdens on low-income households. Will these reforms accomplish all these promises attached? This is the Eastern Eye. I am Alex Ogbodo. Welcome to the Eastern Eye, a program that x-rays the political, social, and economic developments around us. Joining me tonight to give us some insights on the Tax Reform Act is Professor Chiwui. He is an economist and the Chairman Board of Trustees, Amaka Chiwui Foundation. Thank you so much, Professor Ba, for joining me tonight on the Eastern Eye.
Yes, I can hear you now.
Okay, perfect. So, I'm sure that you know that you definitely know that the president has signed 4 key bills into law. It's now an act of the parliament. First of all, let's take a look at this way. Was it an act of courage for the president to really move towards getting these tax reforms in place at this time?
Yeah, I think my first answer would be yes. It's an act of courage. If you look at the history, how it all started, you saw that there was a lot of pushbacks from the northern states, the governors, and every other person. But along the line, the president, if you recall then, when we had this initial conversation, I told you that whoever that may have a reservation concerning the bill should send a memo to the National Assembly during the public hearing, and those issues should be discussed. Because the initial pushback was for the National Assembly to stop the bill and all the rest of it all. But as you can see, the president did not only use diplomacy, but he also applied the instrument of legislative process to get this thing done. He recognized the fears or the input of the governors, the northern states, and every other person, and brought them to the round table, but still focusing on what he wants to achieve. And in the end, compromises were made without watering down the real essence of having this law in place. So I think he took a very bold step that others would have taken. Initially, what would have happened is that when such pushbacks happen, the President of National Assembly will chicken out and the bill will be dropped. But in his own case, he said no. Let the process of the legislative process continue, and let whoever has any input to make. And I'm happy that in the end, the bill saw the light of the day, was approved by the National Assembly, and eventually received the presidential assent that has made those bills into acts or laws, as it were.
Yes, the president typically wants to bring together Nigeria's tax administration. He calls it Nigeria Tax Administration Act, NTA. There is also Nigeria Revenue Service Act, NRSA. There is also Nigeria's Tax Administration Act, NTAA. They are all aiming to amplify or simplify taxation, boost revenue efficiency, and reduce financial burdens on low-income groups. There's a mention of where those who are earning $1 million naira or below won't be affected at certain things. Just help us put this in perspective. For someone who's listening, who isn't very vast on issues of tax, what does it mean to have this NTA, NTAA, NRSA, and JRBA, that's the Joint Revenue Board, when you have all these things in place, what do you think the president is intending to do with this piece of legislation?
Initially we have what we call the Federal Inland Revenue Service, which is an agency of the government empowered to collect revenues, manage revenues, and account for government revenue. And that includes both for some of the federally collected revenues that are paid into the consolidated fund. But beyond that, we have other government MDAs or institutions that are also empowered to collect revenues. And such institutions, for example, is the Nigerian Customs Service, the Maritime Authority, and all the rest of it, or that collect revenues for the government. And as you know, for each of these agencies, what they do is that they collect some and they do what they call tax expenditure, and before they remit the rest to the coffers of the government. So what usually happens is that you have a fragmented revenue collection stream that leads to a lot of revenue losses to the government. So the establishment of the Nigerian Revenue Service now consolidates all these things and empowers the Nigerian Revenue Service to be the umbrella that will now be collecting all revenue collectible by the government on behalf of the federal government. So what it means that I'm sure over time the arrangement will be worked out. Whereas the Nigerian Customs Service and others will still act as collection agents, but they will now be collecting on behalf of the Nigerian Revenue Service. So what it may happen is that the Nigerian Revenue Service may now have their staff embedded in these institutions, where they will have overarching oversight on how these revenues are assessed, collected, and accounted for. No longer with the customs and all the rest of it be solely in charge of these things. I think that's a very good reform that has happened. If you go to the UK, that's exactly where they have the customs and revenue service meshed together. So that has come to be. At the state level, that's what we thought will also happen where you have the state internal revenue service that has been empowered by law to be the sole agency for the assessment, collection, accounting of revenues at the state level. But we still find in some states where some MDAs still collect revenues, assess and collect revenues, not as agents to the IRS, but on their behalf, which is not what the law expects. So I do hope that with the NRS at the federal level, these other agencies of the government will only act as tax agents to the Nigerian Revenue Service. So that is that on its component. Now, the tax administration law, what it has also done was to collapse all the multiple taxations, about 50 taxes that have been collected over time, into a minimal tax structure that allows people to know what to be paid and when. And also reduce tax burden to the lower income earners, even though if you look at it also, Nigerian tax system is still largely indirect tax system, so which in the end also still places a lot of burden on the low income earners or the poor people as it were. But with this tax administration law, it has reduced the burden. When you started, you said that those whose annual income is less than 800,000 naira are fully exempted from tax. And a section of the law also says that if you're in about 108,000 naira monthly, you're also exempted from tax. So what it means that for low-income earners, those who are earning minimum wage, as it were, they are now fully exempted from tax. Then for VAT also, there's also an expanded VAT exemption on certain items, which are naturally consumed by lower income, and that's what we call the essentials. Like for food now, there's no VAT anymore. For pharmaceuticals and all the rest of it, VAT has been removed from them. But the other component of this is to make sure that also those who are earning bigger funds begin to pay more tax. So progressively, if you are earning a higher income, what it means that your tax will be progressively charged till about 25% of your earning. So if you are earning like 50 million naira, so it's equivalent that you'll be paying like 25% of that 50 million naira as tax to the government. And I think that's something that is also good, where you pull from the rich and also give to the poor to provide those. So that was also. Then the other thing that has all changed is on the capital gains tax, where the government has raised the capital gains tax from companies from 10% to 30%. So what it means that when, as a company, when you resold your assets and make a profit on those assets, whatever gains you make from those assets, 30% of it will be paid as tax to the government. So what it means that government will generate more funds from that. But I think what these laws have come to do is to streamline processes and also strengthen institutions, hoping that the institutions that the tax laws aim to strengthen, that there will be political will to get those institutions to work as envisioned in the respective tax laws.
All
Then
right.
initially, then also the joint revenue board has replaced the joint tax board. Initially, you have the joint tax board. The joint revenue board now has replaced the joint tax board, where you have all the IRS and every other stakeholder to be part of this new board as well, for the effectiveness and efficiency of tax administration in Nigeria.
Okay, let's talk about value-added tax. Just for some reason, a lot of people are interested in the value-added tax and the way the value-added tax is shared. And help us put it in perspective. With the new sharing formula, is it now Uhuru? Do you think this is now music to the ears of the subnationals? Or is there something else we need to understand?
Well, I think the subnational, based on the new sharing formula, received additional 5%. Because initially they were receiving, let me just confirm so that I don't say something that is not what the law says. Initially, the subnational was receiving, they are now receiving 35% from the 30 they were receiving before. So states will now be sharing 55%. Initially, they were receiving just 50%, but now they reach additional 55%. State government, federal government reduced theirs from 10%, from 15% to 10%, while local government retains at 5%. But within the states, the sharing parameters change, where 50% will be shared equally among the states. Now, 30% will be shared based on location of consumption, and the remaining 20% will be shared based on population. So what he says here now is that if you are generating more, 30% will be shared based on that basis of what you are generating from your area, where 20% is on population and 50% based on equality, based on equality. So what has happened is also that it has given state more VAT, more money to share among themselves. And also for those who are producing more, where consumption is taking place, a more leverage to benefit from the consumption happening in their locations. So at subnational level, they have more money from VAT, unlike before. Now, federal government is just taking 10%, where the subnational is taking 90% of the VAT.
I mean, for some people who don't understand some of the issues around VAT distribution, and now if there's high consumption in your state, some people were just not quite comfortable with the whole VAT alignment before now. Do you think that what has happened now will calm frayed nerves? Or do you think that there will still be some people who don't like this development?
Well, I think, like I said when I started, compromises were made along the line. If you recall, when the initial bill was submitted, this was not the distribution parameters. They had wanted more percentage to be allocated for based on consumption. But given the pushbacks that were received from states and all that, I think that was amended to assuage the feelings of others. But I think this is a progressive reforms. Over time, I'm sure the government will still come back to say, okay, we've tried this. Now you are getting more. Even the states that kicked against it now, if they are generating more VAT now from their locality, might be the ones that will say, okay, let's increase the parameters leaning more to consumption than equality and population. So it's a work in progress. So for now, what has happened is that those who felt earlier on that they are generating more VAT and getting less received little things more, and those who have been accused of taking what they are not generating, gave in little thing more, but they also feel very, very more happier that they didn't lose entirely.
Okay, I mean, let's shift now our attention to corporate income tax, CIT, which of course there's a reduction. The rates will decrease from 30% to 27.5% in 2025 and 25% from 2026. And with small companies, annual turnover 100 million and fixed assets 250 million exempt from CIT, that's the capital gains tax. Help us put this in perspective, because some people say, well, that some of the companies will never want whatever they're doing to rise above these figures. Is that what it will now turn into?
No, I think what the government has done here is to encourage more business holders. Because what we have seen even at the subnational level is that as soon as you start your business, government come with a lot of tax and all that to disrupt that business. And most of these business die even before they start. So in order to encourage small businesses, what government has done is that if your turnover, which is sales, not profit, if your turnover in a year is less than 100 million naira, and your total fixed asset is about 250 million or less, then you are exempted from all manner of tax that are payable. Unlike before, when this is just 25 million naira, if you are less than 25 million naira. So what government has done is to encourage more business holders, to grow their business in such a way that it can now begin to make more profit and begin to pay the required taxation. Secondly, unemployment is very, very high in Nigeria at date. So if you allow the small businesses to grow and build their businesses, they're able also to create employment for the teeming unemployed youth. So, and when these unemployed youths are employed, that has a way of also reducing insecurity, the rising insecurity in our country. And over time, when these companies grow into bigger companies, even those that are working in those companies will begin to pay personal income tax as well to the government at subnational level. And those small companies that have now outgrown the threshold of tax exemption will begin to pay tax to the government as well. So it's a win-win to grow the economy while also making sure that in the long run, medium to long run, these businesses will begin to pay the required taxes to the government. Meanwhile, don't also forget that you need these businesses to move the economy. The state on its own, when I mean the state here, and I mean the government on its own, cannot do everything in an economy. So you need these private sector businesses to keep the economy running. So I think it's a good reform that these tax laws have also introduced in our system.
Absolutely. Capital gains tax is one more thing there. There's been some adjustments. Compensation or damages up to 50 million for personal or professional wrongs are exempt from the capital gains tax, with amounts above taxed at CIT rates 25.5% in 2025 and 25% from 2026, up from 10%. Help us put this in perspective. Capital gains tax. I mean, some people watching us, you have to pardon us, sounding like a taxation class. But that's what it is, actually, because all of us are getting used to what's been signed into law, isn't it, Professor?
Yeah.
Just help us put into perspective what capital gains tax is about.
Okay, because what I'm seeing in your screen now is company income tax.
There's a capital gains tax. They will put it up.
Yeah.
They will put it up.
So let me treat the one you have
on the screen. Yes. Okay, great. The CIT rates, yes.
So company income tax is also the taxes that are paid by companies based on their profits. So as we discussed earlier on, for small businesses whose turnover is less than 100 million naira, they are completely exempt from this tax. And those whose fixed asset is also less than 250 million are exempt. But for those whose turnover is above 100 million and fixed asset is above 250 million, they are not exempted from this tax. So what this law is saying is that based on their profit in 2025, because you know that this law will take effect from January 1st next year. So for 2025, they will pay a 27.5% tax on their profits. This tax is on profits. It's company income tax paid on profit made. Then for 2026, the tax rate will be reduced to 25%, which means also that the government is encouraging even big businesses to begin to do other things. But there's a clause. There are some levies that has been also introduced as part of this law. You know, those levies also, the companies will also pay, and those levies will also become tax exemptable in their overall profit. So what it means that if you have paid education levy, for instance, when you be computing your profit, you deduct that levy you've paid as part of the expenses that arrive at your accessible profit. And when we know the accessible profit, you pay 25%. That's for next year. You pay 25% on that profit. Then if it's for this year, you pay 27.5% on that profit. But there's something I forgot to say, which these reforms is also bringing for even those that are earning bigger money who keeps hiding it. What has happened is that earlier on, what the government has been using is to use your TIN, tax identification number, to track you. But most people, you know, only people register for TIN in this country. So it becomes difficult for government to trace. So what this new law has also done is to allow government also to use your DVN and NIN to track your income using your bank account. So if you have more money in bank accounts and they know this money is coming, government has the right to say, okay, given the money you've made, that you are supposed to pay social tax. And if you don't pay those tax, you even pay penalties based on the sum that have been seen, that we have seen in your bank account. If you can't explain what those funds are all about. Now for capital gains tax. For capital gains tax, okay, we are discussing the company. So what you say here is just for company A, effective tax rate is 10%, then top of tax. Top of tax, it means additional tax that you can pay. You know, for multinational enterprises, is 5%. For company B, there are categories of companies. So you pay effective tax rate is 13%, top up tax is 2%. So that gives you about 15%. For company C, effective tax is 15%, there's no top up. Then company C, 12%. So what it means in all is that every company, the effective tax rate for multinationals is about 15% for their profits, on their profits.
I think we'll have the capital gains tax infographic there, but we'll pull up with that. But just help us explain it a bit, because some people don't quite have a clear picture of what it's about.
So capital gains tax is nothing than, I have an asset. Let's say I have a building in Enugu as an individual, because you have capital gains tax for individuals and capital gains tax for corporations. As an individual, I may have a house that I may have bought, say, 20 million naira. And I've lived in this house, and I want to resell this house, and I sold the house at 18 million naira. What it means, there's a capital gains on that profit, 3 million capital gains on that profit. Naturally, I am supposed to pay government tax on that capital gains made on that profit. That's what he's saying. I'm supposed to pay tax. But what we have seen over time is that people will just sell the assets and pocket everything. Government is not even aware that the asset has moved, changed hands. So government gets nothing from it. So the new law is saying that they will find a way to play. But based on what you have placed here, it's saying that the tax rate for capital gains exemption, if your threshold is between 50 million naira, that it is exempted. But above that, you pay 27.5% on the capital gains. Then for 2026 onwards, why is it not showing well anymore?
Yeah, I mean, it's there. Maybe I think you need to be on full screen. Can you put that on full screen? My friend had a PCR. Okay, great. All right. I hope you can see it now.
So for 2026, for 2026 upwards, it will move to 25%. Still, exception threshold is 50 million. Previous, which is what is happening now, capital gains tax rate is 10%. So this is how it's going to graduate. 27% for this year, 2026 is reduced. But for companies, this is supposed to be for individuals from what I'm thinking here now. For companies, it moves from 10% to 30% from what I read in the law. Even though, like I told you, I've not taken time to read the law.
That's right.
So, but for corporation, it moved a little bit higher to 30%.
Okay, great. We will take a break at this point. When we return, we'll talk about development levy. We'll talk about implications, the issue of compliance, how companies will be reacting to this, and how the Nigerian economy will react to the new Tax Reforms Act. Stay with us. We'll be right back on the Eastern Eye. You're welcome back to the Eastern Eye here on Afia TV, a program that x-rays the political, social, and economic developments around us. My name is Alex Ogbodo, and I'm still having this very illuminating conversation with Professor Chiwui. He's an economist and, of course, the Chairman Board of Trustees, Amaka Chiwui Foundation. Thank you for staying tuned. Let's talk about development levy, which is imposed on accessible profits of companies, well, except small and non-resident companies at 1% in 2025 to 2029, rising to 2% from 2030, and funding education and technology initiatives like Student Education Loan Fund and TET Fund. So help us also to deal with this.
Okay, if you look at it, there's a threshold for those that will pay the levy, the development levy. And it says on accessible profits.
That's right.
So what this means is that also, it says pay 1% funding for education and rental. So for a company, after you have deducted all your liable expenses, because there are some expenses that are not also allowed, so it's not every expenses you make that you deduct as that the tax authority will recognize as expenses. So it's not when you dash people money and say it as an expense. No. So after they've taken note of your revenue, deduct your allowable expenses, whatever thing that is remained is called the accessible profit. So based on that accessible profit, you pay a development levy of 1%. That's what the law is saying. And that 1% levy will be used to fund those various areas that the law has determined. So for instance, you have a business, and at the end of the day, after your income and expenditure, you have an accessible profit of, say, 2 million naira. So what it means that when you pay 1% of that 2 million naira, whatever amount it is what you pay to the government as development levy. Then after which you have now the component that you now pay the 27.5% or 25% tax on in the end, effective tax rate in the end. That's what that's just saying. So what it means is that your levy will be deducted from your accessible profit before your tax rate is implemented. So your development is deducted from your gross profit, as it were, if it's just when you are doing your business. From your gross profit is where the government will apply the 1% development levy. That's what it does say.
Okay, so let's shift a bit now and talk about the implications of all this. Their thinking in all this is that it will simplify compliance for businesses, reduce tax burdens for low-income households, and promote exports. But there's a concern that high rent payers may find the rent relief less beneficial than previous consolidated relief allowances. So those a bit on the higher side might struggle. Is it more like robbing Peter to pay Paul?
No. Remember that part of the key canons of taxation is income redistribution. And for us, we are running a progressive tax system, not a regressive tax system that as it were. Because in the end, most rich people in this country evade and avoid tax. But what this thing has done now is to recognize that the poor who has been bearing the tax burden over time, get some relief, and those who have been evading tax, because that's when we talk about compliance cost. The collection strategy, the IT infrastructure that the government wants to deploy will make the collection cost cheaper for the government and reduce people's ability to evade and avoid tax. So what it means that if you are earning higher money, you should be able to release some of those funds to the government or to the state to provide the facilities that everyone will enjoy. Why God has blessed you more is to allow you also to support those who are less privileged. So you can't keep acquiring without supporting others. So the system wants those who are earning more to support those who are earning less. That's what it is. But like I said in my introductory statement, yes, these reforms are good. It's a work in progress. Over time, the government will look at it again. I said also that in Nigeria as a date, Nigeria still runs more on indirect tax system more than direct tax system. And what that means is that because of different levies, different indirect taxes in different things, even on VAT and all that, the burden of taxation still moves to the higher, the poor people who consume those kinds of things. Yes, I'm happy that the VAT has, given more exemptions on essential goods. But even at that, they still need to look at those issues from time to time to see what the impacts are. So it's not so bad that those who are earning more are going to pay more. It's progressive. So if you earn more, you pay a little bit more. But what will happen is that except the system that will allow government to also track and collect these taxes are put in place, it might still be very difficult, because what you have experienced over time as a country is that the high net worth individuals rarely pay tax, whether it's personal income tax or corporate tax or even capital gains tax. They rarely pay tax because government on its own, those that sit on those seats at the higher level, rarely go after those high net worth individuals because of political consideration. Because if you pursue those people so much, they can raid the vote, and every person in authority wants to go for a second term, also be in charge to produce a successor.
That's right.
So there are where you hit those people, they will pull the rug from your feet.
All right, so let's talk about income monitoring. They say financial institutions must report individuals with monthly transactions, 25 million, to tax authorities, expanding the tax debt for high income earners. So just like you referenced in the beginning, this whole reforms is taking a look at those whose bank accounts are fat enough to produce a lot of excess liquidity, isn't it? And I don't know whether you heard me, Professor. Yeah. Yes, I'm saying.
Yeah. That's what it is. Yeah, that's what it is. What the government wants to do, even before now, the tax law makes it mandatory that the banks should provide a tax revenue authority with records of people's banking transaction on daily basis. But that component, as I said, are rarely enforced, because also what you have seen also is that banks are also very careful not to lose their big customers. The same way government at both at federal and subnational level are also very wary of pursuing those high net worth individuals. So I just hope the political will be there to do that. So what government wants to do is that if you have an inflow between 25 million naira and above, bank is under these laws now mandated to report such transactions to the tax authority. Because that will help the tax authority now to also monitor the individual to see how much money is coming and to see whether he is paying the rate tax he is supposed to pay. So if you are making a transaction that exceeds that amount in a month, that means that you are getting more money. If at the end of the day you go to IRS office, like most people will go, and say, give me, what do you call it? Give me tax clearance or tax receipt, and you pay 10,000 naira. What it means that you are breaking the law because you are evading tax. And tax evasion is a criminal offense. So in addition to paying the required penalties, the tax authority may decide to prosecute you and jail you for that purposes. So that's just what it means. So if your transactions are at that level, so you know that the banks now, under this new law, have been mandated to be submitting your reports to the tax authority. The same way the banks under the law are mandated to submit certain transactions to the EFCC and all that, for monitoring and all the rest of it.
So let's talk about something else, which is digital compliance, which is will be introducing mandatory e-invoicing, real-time tax remittance, and value-added tax fiscalization to enhance compliance, particularly for digital and non-resident businesses. Is this aiming at stepping it up digitally in the collection of taxes in Nigeria, especially for those who are also not from Nigeria, as it were, or in Nigeria?
What this means is that even though they started it gradually even before now, but now the law is making it mandatory. There are a lot of content creators. I'm just using Facebook as an example and YouTube. A lot of people are collecting billions of naira on daily basis from YouTube and all those kinds of platforms. I'm just using that as an example. And most times they pay little or no tax to the Nigerian government because these revenues are not tracked. What the law has done now is to mandate the government and the users or managers of those platforms to report appropriately, that to deduct those equivalent of those taxes from the revenue or income accruable or collectible from those people and pay the tax equivalent to the Nigerian government. Because it's now a law. So if YouTube that has monetized, somebody who has monetized his Facebook account, and Facebook has paid you $100,000. If Facebook fails to remit the tax deductible from that to the Nigerian government, they've broken the Nigerian law. So Nigerian government can get that money back from Facebook. So what Facebook is supposed to do now is that at each particular time that people are getting money from them or from other sources digitally, such deductions has to be made and the funds remitted to the Nigerian government. That's what he's just saying here.
All right. That is the concern as we wrap up this conversation, that state and local government revenue that might be at a disadvantage. Yes, it is agreed that the subnationals will have their revenues increased, but there may be a disadvantage to states with lower value-added tax contribution. And they are saying that digital oversight could burden businesses transitioning to new systems. There are people who haven't quite gotten a hang of the whole digital setup. How do you think all these things can mix and meld and metamorphose to something really productive for Nigeria?
Like I said earlier on, this is a work in progress. Any new law or new system cannot benefit everybody at the same time. So what will happen is that also the system will allow hand-holding of the ones that are done and bring them up. And what also we have is also peer learning approach. If state A is doing well, what I will expect state B to do if they're not doing well is to learn from state A what they are doing to make sure that they measure up what is required to begin to tap from those potentials and all the rest of it all. So it's a process. And that process, we must recognize, is a process. So for those who are not going to get much from consumption tax, say value-added tax, as it were, but do not forget that based on consumption or locality of consumption is not so high, also it's 30%. So, but even at that, what it means that every state must put things in place to attract people into their state that will begin to increase consumption cases. If you look at generate more VAT than Enugu and Imo. So the big question is that why will a boy be generating more value-added tax than this state? So it belongs on Enugu and him and Anambra to find out what is a boy doing that is giving them leverage to generate more value-added tax in a boy state and begin to do things that will get them to that level, if not more. So I look at this as an opportunity for lesson learning, experience sharing, and also improvement. It brings innovations and competitiveness among the subnationals also and at the federal level too.
I just want us to touch on withholding tax before we wrap up the conversation, Professor Oba. Effective January 1, of course, the new withholding tax rules clarify deductions for companies, capital gains, personal income, and petroleum profit taxes with reduced rates for low margin businesses. They say penalties for fake receipts and non-compliance are also reiterated. This is, so a lot of people don't know there are fake receipts, but then at the end of the day, withholding tax is real, isn't it? I don't know why you're laughing, Professor Oba.
I'm laughing because of the fake receipts.
Fake receipts. Yeah, some people have worried that some people say that's a fake alert. I'm sure you've heard one or two things about it. They say fake alert. Somebody will be crying by the side of the road that someone bought something and gave them a fake alert, and here they are, story of their life. But just help us put this in perspective. Withholding tax.
Yeah, but the problem, I think this is more based on companies. For some of us that do consultancies and all that, those who you've provided services for, most times will do your withholding tax. They do withholding tax.
That's right.
But sometimes you don't get even to get receipts allowed as some money has been credited to your account.
Yes.
Yeah, they deduct, but they don't really would they remit such monies to the state internal revenue service or even at the federal level. And when you push, they issue you some receipts, which in the end may become a fake receipt. I'm just using that as an example. So what the government is saying under this rule is that if any reason fake receipt for withholding tax is issued, that's a penalty. There's no mistake about it. And if you deduct, the law even said, the former law says that if you deduct, you need to remit within 7 days of deduction. But sometimes you've seen companies that deduct, I will never remit it till thy kingdom come. So given the digitalization of this whole stuff also, it will become easier for both the Nigerian Revenue Service and the constituent states internal revenue services to begin to keep tab to these things. Like I said, I still maintain it's a work in progress. It's a work in process. We might not begin to enjoy the benefits of these things at the immediate, but within the medium and the long term, if the implementation and continuous reforms continue to take place, we might begin to see the values, accruable or determinable by the reforms. And also, as we begin to implement the tax laws, we might begin to see areas that needs to be amended or strengthened in order to achieve the key objectives of the tax administration law.
As always, it's always a pleasure having you do analysis here on the Eastern Eye, Professor Chiwui, Economist, and of course, Chairman, Board of Trustees, Amaka Chiwui Foundation. Thank you so much for your time on the program tonight.
Thank you.
And that's the Eastern Eye for tonight. We'll be here tomorrow to talk about something that affects your health, what you eat, and the drugs you take. Keep a date with us, 7 p.m. tomorrow. My name is Alex Ogbodo. Good night.